We need your support. Click the like buttons below. Now onto the video. Welcome to readtheticker.com. This is part 2 of the series. I wish I knew this when I was 22. Now, readtheticker.com was developed as an exploratory method of using some technical tools. One of the technical tools I found very useful was actually using quarterly bar charts. We normally have daily, weekly, monthly, so I decided to include quarterly. The reason why quarterly was included, just for the reason, is that most returns of companies' information is on a quarterly basis, so therefore quarters have an influence. So I think hedge funds also report quarterly as well. Anyway, so here we have quarterly data of the NYSE going back to 1967. It's in the report format, so it's just as reported. Another point is that quarterly data, obviously a quarter is made up of 12 weeks, been in about 62 trading days, and if you're a Richard Ney, Wyckoff, Bob Evans type thinker, and you're attracted to bases of distribution and accumulation, well, indicators on quarterly charts are very sensitive, like very sensitive indicators on quarterly charts helps you find divergences and also bases of accumulation and bases of distribution. So let me explain a bit further. So here we have our quarterly data on NYSE. We have an indicator, and we have the log data of NYSE quarterly data, just so we can see the bumps and humps a little bit clearer. Now, this is what I wish I knew. Here we have an indicator called the copy pot curve, or the co-pot curve, whatever. Okay, so now we have here settings of quarterly 1, 1, 2. Now the first two ones are loaded into the copy pot curve of the rate of change. This curve is made up of two comparisons of a rate of change and a weighted moving average, and I've set each rate of change to 1 quarter, and a weighted moving average to 2. And what we can see here, when the red line breaks is obviously down, the blue line breaks is obviously up. So when the red line recovers, that's a trend reversal. So if we had investment decisions, or we considered investment decisions around the trend reversal, here, and also the blue one, because obviously it broke the zero line and come back up. One's here, it's a false move. There's a couple here. Let's go back to 1987. There's another good one there. Where are we? Oh, we are on there. So as you can see here, there's about 1, 2, 3, 4, 8, 11 decisions and about one false move, which is in the 2002 sell-off. So if you're a solid long-term investor, invest in the best sectors and the best companies by relative to strength. Over a period of time of 10 years, you really want to know the definitive time of the market moves. Okay, so the quarterly data with the right sensitive indicator helps the long-term investor to decide whether this passage of time, these 12 weeks, or even 6 months, is the time when trend has actually changed. So 3 months of the market is pretty important, as due to its nature of the earnings reports. So a change in trend can happen over 3 months as a base is formed, and a quarterly data with the right sensitive indicator can help highlight something big is going down. It just highlights that. And once you can also use this on individual stocks, individual sectors, commodities, currencies, and it just says the big ship has turned and now trend has changed, and you apply your Wyckoff or detailed analysis to those 3 months that you're studying that's caused the change in trend. Let's just go to show, once if you get a signal which is rare For example, this is rare, whoops, turning up here, right? Its infrequentness gives the signal its credibility. So I wish I knew that was when I was 22, and I knew that, and it would have helped me over the last 30, 40 years. Oh, not 40 years, like 30. But it's definitely going to help me for the next 10, 20 years I'm around, and has helped me for the last three years. So take into account quarterly data with the right quarterly indicators to deal with the rate of change. I use this one here. Can help in your investment career. Thanks for watching.